investor. We're talking real money.
Hello, everybody. Welcome back to Talking Real Money. I'm Don McDonald. It is good to have you along for this hour of the program or this episode of the show. And I didn't believe it. I see it and I believe it, but I wouldn't have believed it if I didn't see it. Tom actually left a soccer game before it was over and came back to do the show.
Well, basically I had to because I heard you saying something about seeing faces in the sky or something. So I thought, well, you shouldn't be getting into that stuff until later on Saturday. I mean, that's not a midday thing. That's like a cocktail hour. So it can make me kind of nervous.
Have you ever looked at a floor made of some sort of stone and you go like, look, there's a face, there's a dog. We see patterns, that's all. I was just talking about pattern recognition. Hi, everybody. Don here, Tom there. We're talking real money because that's the name of the show. And our phone number is 855-935-TALK, 855-935-8255. Now, we've talked a lot about the fact that there are two things that drive investors. There are two things that really drive people: greed and fear. Now, greed is what drives people to buy stocks or gamble on crypto, things like that. Fear is what drives people to invest in gold. And about a month or so ago, the Wall Street Journal printed an article called "Individual Investors Seek Safety in Gold." Their argument being, well, since gold hasn't returned much, as a matter of fact, gold has returned less than the stock market over the past 10, 20, 30, 40, 50, 60, 70, 80, 90, and 100 years. Now, I believe you could even take that back to 2,000 years, but we're not going to go there. So the only thing you have left that makes gold make any kind of sense at all is the fact that, as one guy said in the article from Massachusetts, he goes, precious metals are kind of what just makes it so I can sleep at night. Gold feels good. It feels safe. But is it? Well,
no, it's not.
Well,
I mean, it is and it isn't, right? I mean, it is.
It depends on how you measure safety.
You have something.
Well, but you have a rock.
Yeah, right. I mean, sure.
Okay, it's a rock. You have a rock that could be shaped as a coin. You could throw it at somebody, I guess. Yeah. But how do we measure risk?
That's true.
How do we measure risk? Really? What's the measure?
At the end of the day, really, volatility, how much things go up, and more importantly, how fast they go down.
Yeah, because if you own all of the stocks in the world, let's just say you own all the stocks in the world, then you own a share of all the publicly traded businesses in the world. Can they all go to zero?
One day they will all go to zero.
No, they won't. Okay, but it could be 10 billion years from now.
Oh, you're saying the Earth will continue on forever? Yeah, okay.
Well, no, okay, but the odds are, as long as people are around, we will have businesses and they will have value. So really the only measure is a thing called volatility or standard deviation. Now, is gold less volatile than stocks?
Boy, I don't know the answer to that, but the setup here.
Don't you love the setup? Well,
I'm going to say not. I'm going to just go with no.
Here's the standard deviation of intermediate term treasuries from 1971 through 2023, through August 2023. So these are recent numbers.
And what the heck is standard deviation? What is
standard deviation means the percentage of volatility. So how far it moves up and down from no change whatsoever. So a low number means it doesn't bounce around much. A high number means it bounces around a lot. So gold should be a low bouncer, right? Low bouncer.
Yep.
Intermediate term security, treasury securities, 5 standard deviation, 5%. U.S. stocks, 15%. Okay, that makes sense. Treasury stocks, right? Stocks are more volatile.
Treasuries, you've always gotten your money back when you were promised. Stocks move around.
International stocks, a little riskier, 17% standard deviation over that many-year time period, 42 years. How about gold? Same time period. Nice, safe gold. 20% standard deviation.
Wow.
Higher than all of those other more dangerous securities, supposedly. And has gold made you any money? Well, we'll talk about that soon. 855-935-TALK.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
855-935-TALK is our phone number. Just one more fascinating number on gold before we go to the phones. Over that same period from 71 through 2023, gold, the worst 20-year return for gold over that period was a 59% loss. 59% loss was its worst 20-year return. The worst 20-year return for U.S. stocks was a 254% increase.
Wow. Should tell you everything you need to know.
No gold in the portfolio. 855-935-TALK.
No gold.
Stephen, you're up. Welcome to Talking Real Money with Don and Tom this time.
Well, thank you,
Hey,
gentlemen.
Stephen.
Thanks for taking my call. So I'm a Washington resident. My wife and I are retired. We want to sell our home in the Seattle area and buy a smaller home outside of the state. People are talking to me about a home equity line of credit. And I wanted to see, does that make sense to you? That we take a home equity line of credit on our current Seattle home, and then we pay off the new home. We sell the current home that we're in, and we should make considerably more money on that Seattle home, and then we pay off the HELOC. Does that make sense to you?
Why not just cut out the middleman?
Well, no, I think I get it. What they're saying is the purpose of this is to allow you to live in the Seattle home right up until after you close on the new home. So you can take your time and then pay off the HELOC.
Exactly. We just want to move one time. So we move out of the house and go out of state, but we purchase it because we have that HELOC. And then we empty our home is empty here in the Seattle area. Realtors say empty your home before you sell it. That way you can stage it better and you can probably earn a little bit more or get a little bit more money that way. But
okay. All right, I'm buying that. So what's it going to cost?
Yeah, there you go. That's the issue. What is the loan going to cost? Because closing costs on HELOCs can, be 2, 3, 4%.
Yeah, could be. But let's say, again, we sell our home in the Seattle area. It's going to be well over $1 million. The home that we get out of state, that's going to be in the $750,000 range. Mm-hmm. So we're making money. We're going to be able to take, I'm assuming that we can deduct these interest rates and things like that when we go ahead and at selling costs, things of that nature. I may be wrong.
Yeah, no. That's but that doesn't. You still are going to end up out of pocket many thousands of dollars on the HELOC. You're going to end up out of pocket. It's just mainly because financially it doesn't make a lot of sense.
Right.
Psychologically, it may very well make sense. What a lot of people do in this situation is they go out and try to identify the home or the area they want to buy in, and then they sell with a contingency.
Well, and by the way, I will add another one that they do. I mean, in today's market with inventories in the Seattle area, frankly, at record lows, you can kind of say, we'll sell it to you, but we're not moving until blank. Yeah. Give yourself plenty of time and make that a condition of closing.
Yep.
That is not an unusual thing to do in today's world.
Oh, okay. Okay. You know what? That makes some sense to me. I appreciate that.
And I think it'll save you a whole heck of a lot of money. And it is done Tom's right. It's done all the time. It's a contingent sale. It's contingent upon these particular things happening. You identify a new house, you close on the new house, then the owner picks up the one you're in. And there can be certain penalties for you not making it on time, or you pay them rent, or if you have to stay a little longer. But this is done a lot, and I think for a lot less money than getting a HELOC.
Sounds good. Gentlemen, thank you. Appreciate your help.
You're very welcome, Stephen. Thank you for your call. 855-935-TALK, 855-935-8255. Amy, you're up next. Welcome to the show. Hello, Amy.
Hello?
Hey, Amy, what's up?
Hi. Is this the Don McDonald?
This is the Don McDonald. Yes, I'm the only one left.
Hi.
Yeah, I've had all the other ones. I've had all the other ones killed off, including the famous architect in Texas and the tattoo artist named Don McDonald. Oh, and the former Prime Minister of Australia. So I'm the only Don.
What about
McDonald.
the guy with the hamburgers?
There was no Don McDonald. It was.
Okay.
It was Ray Kroc.
Ron McDonald, wasn't it?
Ron.
Okay, Ron and Ray, and
Amy, you're opening a can of worms now. What's up?
I recognize the voice. I know it's the right Don.
Okay, good.
I've got a question for you.
Yes, ma'am.
I have a lovely 96-year-old mother who is in fantastic shape. And she is always talking about trying to save some money for her 4 children when she dies. And we keep telling her, let's go on vacation, spend your money. So the bottom line is she has an IRA and a moderate growth IRA. And I'm wondering if you have a suggestion for moving her money out of an IRA and putting it somewhere where she might make more yield interest on it so she can enjoy her time and make a ton of money in the next 3 to 10 years of her life, however long she lives. Because it's a good day to celebrate
so I want to make sure I get... Yeah, make a lot of money, don't take much risk, and have a high yield on it. Is that what you're asking for?
Yeah, in a short amount of time, assuming that...
In a short amount of time.
Okay.
Oh, she got the big
easy.
4. Got the big 4. Yeah. Which 3 don't you want?
About 100,000.
Which 3 don't? Which 3 things are you willing to give up? You can have 1, maybe 2, but you can't have all of them.
Oh boy.
Yeah. See, you can have safety.
Okay.
You can have liquidity. You can have high returns. You can have
maybe
the potential of high returns. Yeah, potential of high returns. You can have pick 2.
Yeah.
You can't have all 3. As a matter of fact, you could probably only have 1. And the fact is, she's got money in an IRA. Isn't she taking money out every year?
Yeah.
Well, why doesn't she just go ahead and spend that on vacations?
So she can just take more. Well, she keeps talking about worrying about the taxes. that either she'll have to
she takes out more money than she pays in taxes.
Yeah.
Yeah.
So just leave it where it is and take some out and enjoy it.
Here's the problem, Amy. When you tell us moderate growth, that could mean a very wide range of things. For us to tell you, keep the investment as it is, we don't know enough to tell you that. But
where is it invested?
Yeah.
Yeah.
Where's it invested?
I don't have that information in front of me.
Okay.
Some IRA.
Yeah, I will add one thing because I think, what you said is absolutely right. Spend the money with your family. Do it today. Your mother's 96. Bless her. I think that's great. Take more than the required minimum distribution and go on a big trip, all of you. I think that makes total sense. Really
and who cares about the taxes? You're paying taxes on money that was tax-free forever.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hello again. Welcome back to Talking Real Money. Don here, Tom there, you there, money out there somewhere, and you're trying to get more of it. And you're trying to do it without taking any risk. We get it, but we're going to be real. We are going to get real here on this show because we call it Talking Real Money. The reality is you can't always get what you want, but if you try sometimes.
He is 80. You should start listening to him now. He's 80.
Who's 80?
Old. Can you believe he's still dancing?
Mick?
Who's the guy who said you can't always get?
He's 80
years old. He's 80.
Jeez Louise.
New album coming out in a couple weeks.
I know. I
or
saw
something.
that. Wow.
Crazy.
855-935-TALK. Give us a call. And Corby, it's your turn on Talking Real Money.
Hi. Thank you for taking my call. I have a question. So I'm retired, but my husband has about 2 years left to work. He's maxing out his deferred comp with putting in about $27,000 a year. And we have about $1,000 extra a month to invest. And we have a mortgage right now at 2.3%, and we owe about $283,000, and it's a 15-year mortgage, so we only have about 13 years left on it. And I'm just wondering, for the past 7 or 8 months, we've been paying an extra $1,000 on the principal of the loan.
Nope.
I know
Nope.
it's because you're only earning 2.3% on the money. But anyway, I was just wondering if a suggestion of what can we put $1,000 into a Roth IRA if he's maxing out his deferred comp, or what do you suggest we maybe do with the extra money that we have each month?
Well, okay, back to that question. Absolutely. But first of all, you answered your own question. You should not be putting money additional towards a mortgage where the interest rate is at basically 2%. And number two, around this, if you're retiring soon, you're going to need liquidity. So it doesn't make sense to be piling money into that. I think that's spot on. Then the next question is, Corby, is your partner, are they Roth eligible? In other words, what is the household income? Can you go ahead and make a Roth contribution? Remember, if figure about 180,000 or so, and if you have income above that, you cannot put money into a Roth individual retirement account. Is that the case here?
Well, our combined income would be over 180. Yes. So we're married, and so we file.
So that would
jointly.
Then here's what I would do. Just let's make this simple. You could do backdoor Rothing and all this confusing stuff, but the reality is, you can take that $1,000 a month and you can put it into a brokerage account and create a portfolio of ETFs that's fit for your risk tolerance and risk profile, and ETFs, growth-oriented ETFs, are going to have very minimal taxation, and on the bonds, you'll pay a little taxes on the income, but you're going to pay fewer taxes than you're going to be making money.
So what does the ETF stand for?
Exchange Traded Fund.
Oh, exchange.
it's the cousin of mutual funds, right? It's kind of the offshoot.
My mother, she has some municipal bonds, and I guess you don't pay taxes on that when you draw that out. Would that be something we should do? Maybe.
Well, okay, that could be the bond. That could be the bond portion of your portfolio, but these days, in fact, we're going to do a show on this not too long from now, on how municipal people are trying to cut off their tax tax nose despite their income face, or I don't know, something like that. Exactly. And so what's happened is the yields on municipal bonds have fallen to the point where, except unless you're in the highest tax bracket, they don't even make sense anymore because people hate paying taxes so much. I think it just makes more sense to build a good portfolio, which means go to talkingrealmoney.com and both of you take the risk quiz. Determine what your risk tolerance is. Then you take that $1,000 a month and you put 50% of it in a total market ETF, total stock market ETF, and $50,000 in a total bond market ETF, and rebalance every year, and you'll be fine. And don't overthink it, because that's a way to make decent money over time with a little risk, but not terrible. Thanks for the call.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hello, friends. Welcome back. I'm Don McDonald. Tom's over there. This is Talking Real Money, the place where we try to make money a whole lot easier to deal with than it was before. 855-935-TALK is our phone number, 855-935-8255. And Tyler, you're on. Welcome to the show.
Hi, Don and Tom. Thanks for taking my call.
Our pleasure.
So I just first off want to ask how I get a Talking Real Money t-shirt so I can advertise for you. I try and refer all my friends and family to you.
Tom?
That's easy. Go to talkingrealmoney.com, click on Meet an Advisor, put your name there. I'll send you one.
Just write down you want one.
And phone number so I know to call you. Yeah, just say you want one. I'll send you one. Of course. Thank you. Appreciate it.
No, thank you. I would go to Washington or Florida, but I'm not anywhere close to either of those. So thank you. I'll do that.
That's quite all right, too.
I'm not allowed to have any T-shirts in Florida anyway. They won't give me any. Even though I created them, they won't let me have any.
They're a nice shirt, too, by the way. But, yeah, so just go talkingrealmoney.com, click on Meet an Advisor, give us your name and telephone number. We'll call you, get the info, and send it off. How can we help today?
So my question is probably for Don because it's about I-bonds. And, Tom, I know you're not a fan.
Well, was I ever right about that one? Okay.
No, I didn't say they would stay there. I never did.
You can speak to the promoter-in-chief of the I-bond. The government calls him regularly and says, can we do another promotion on Talking Real Money? But go right ahead.
So I bought some I-bonds, and now their fixed rate is 0. And I'm looking, you mentioned some money markets on your last podcast, and I looked, and I can get over 5% there. Where right now, with a 0% fixed rate, my rate is 3.38. Mm-hmm. Is it worth switching over, or do I just write it out? With that
how long have you had them?
Since 2021.
Okay. My thinking is it's not worth it. I would leave it alone because I got mine as purely as an inflation hedge, which means in times of inflation, they're going to make me better money. In times of less inflation, they're going to make me worse money.
And also, don't they grow tax-free where the money market would be taxed?
That is also true. Well, they grow tax-deferred. Yeah, they do.
Deferred, not free.
Deferred. There's a difference.
Yeah.
But no, I because there are really 3 ways to hedge inflation. The most obvious 2, the safer 2, are tips and I-bonds because they're backed by the full faith and credit.
Save it too.
The other one are stocks.
Things won't be more
but
expensive.
It's not as they're a lot more volatile. So if you got into them for the right reason, you don't get out just because then you're going to end up chasing yields, which is not the point.
Yeah, that's
right.
That's what worries me. And by the way, somebody today, I haven't had a chance to open it because I was at 2 soccer games today, but somebody sent me an article about getting 6% now on a 1-year CD. I haven't had a chance to look at it, but
but see, we're always always trying to chase the hottest thing, and you're always going to be a day late and $1 short. You're never going to be able to pull it off on a regular basis. So my thinking is if you got in because it was 9%, that wasn't the right reason. The right reason was, we've got inflation. I don't want to make nothing on my money or less than nothing as inflation eats it up.
Okay.
All
right. Well, thank you so much. I actually think you two are the hottest thing, and I can't wait for that T-shirt.
Okay. Thank you very much.
That's very, very kind. Thank you.
Somebody didn't think we were very good.
I think we should end the show right there.
We got a bad review. Somebody saying we said bad stuff about that.
What?
They said we were wrong about Social Security. I can't think of a single thing we've said wrong about Social Security, but they didn't say what.
This is going to be a hot topic next week. I have decided personal mission. Today, it's only 10%, less than 10% of Americans who wait until age 70 to take Social Security. That is a horrible decision. So next, I'm going to make it my personal goal to increase that to like 50%. No, I am because for most people, it's most of their retirement. They make a whole bad decision about it, and it's costly for years. And yes, I know you got to live till 80. We can get into all that, but please wait on Social Security. My goodness.
But that was just a tease for his future episode where he's going to do it nonstop. All he's going to do for the entire show is go, wait. Just Social Security, wait. So Social Security, no, wait. That'll be when I'm gone, which is next weekend. Have a bit of a family crisis. A lot of a family crisis I need to attend to. 855-935-TALK is our number. 855-935-8255. Give us a call.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Because money, wow, it's a really big part of your life. That makes it real money. And you need to really understand it. And we have a phone line that allows you to ask us questions, so you can. 855-935-TALK. 855-935-8255. And Santos, welcome to Talking Real Money. Santos? I don't even hear phone sounds.
No, I don't hear anything.
And I'm still connected to the station. Yeah, I am.
Hello.
Hi, is this Santos?
Oh, there we go.
No, this isn't Santos.
Oh,
Hello?
okay. Oh, Santos. Oh, it's Rachel. Hi, Rachel.
Yeah.
You're the next call. Okay, the Santos went away and you came in his place. Now I'm getting it. What's going on?
Santos.
Well, okay. So thanks for taking the call. So over the last 2 years, my investment, I'm retired and I'm invested in mutual funds, and then that pays me a salary every month that, that I take every month. And so I'm looking at my total investments, and they've gone down like 30%, I would say, from the high point of where they were. And my dividends don't seem to be paying out quite as high as they were. And I'm just not sure what to do. I feel like, a deer in the headlight. I don't know whether I should take and reinvest some of those and take the loss on them. I know I can do that, claim a loss on my income tax, but I'm not really sure what a good strategy is now, or just sit and wait.
Well, there's no your strategy should come later. Right now, we got to figure out what you're trying to get this money to do and how you're doing it today before you strategize. Or where is this money invested first? Right, since it's not doing well, I'm very confused.
Oh, so they're mutual funds. So there's a group of funds that I invest in, and maybe 6 different ones that are in my retirement account.
Can you give us any names?
IRA.
Can you give us any names of any of the funds, Rachel?
Yeah.
Do you remember any? Sounds like you're driving, so don't look and drive.
Yeah.
Please don't. Yeah.
Not like, I don't think it's Putnam. I don't think I'm with them anymore.
Okay. How did you get into these funds? Did you get them on your own, or did a broker help you get them?
Well, a broker, and I've gotten advice. So, and they had been doing really well for me.
Okay, here's what it sounds like. It sounds like, Rachel, it sounds like you're getting the typical American financial advice. And that is, you go to somebody and you go, what should I invest in? And they go, here are some great ideas. And then they work for a while until they don't. You don't have that's tactical investing, and you need strategic investing, which requires you start with a plan. Do you have a financial plan?
Well, so what, I just want to be able to take the money. I have a retirement amount that I invested, and I liquidated some real estate and converted that into mutual fund stock. And then like Nuveen was one of them. What is the other ones. I just don't have them. Can't.
What was the name of that? What did you say that name was?
Nuveen.
Oh, Nuveen. Okay.
Nuveen.
All right. You're getting stock. You're getting commission funds from a broker. Now we know what kind of a person. We know now. We are relatively confident that you are not getting planning advice. You're getting investing advice.
And it's coming from someone who is not a 100% fee-only fiduciary advisor.
Right.
Period.
We know that.
That is an issue.
Okay.
You need a plan. How much money do you have altogether invested?
It's quite a bit. It's more than I want to say. But yeah.
All right. More than you want to say. So it's an important amount, but you need it to generate an income for you. That's correct?
Right, and it has done that quite beautifully. And then in the last 2 years, and it's still paying quite well, but a little less. But I'm just looking at my, what I have in the funds is going down. So, like,
right, which concerns me, Rachel, because we are currently in a market that is doing relatively well. So
it should have made money this year.
It should have made money this year, and that's why I think you've gotten some bad advice that worked in the past and doesn't work anymore, because you've got somebody who's picking the hot stuff for the time and then fails miserably at it. Here's what you need. You need a real advisor. You need to fire this person you're working with. Fire them.
Okay.
They're not working in your best interest. I can tell you that just based on Nuveen, just on the word Nuveen and Putnam. 2 words, Nuveen and Putnam.
Yeah, we know those.
You need to find yourself an advisor who is a true fiduciary advisor, and they're hard to find. Go to talkingrealmoney.com/help. And that'll help you determine how to find them. But first off, you got to fire this guy. Then you've got to sit down with someone. And if someone doesn't sit down with you at the very first meeting and say, what do you need this money to do for you? If they don't say that, if they don't ask that question, then they're another stock jockey or mutual fund jockey.
Or a product pusher. I mean, and again, Don's exactly right. Once you have the plan in place, because it's meaningless to us to tell us I've lost 30% over the last year. I don't know how much you've taken out of the portfolio. I don't know if that means certain parts have gone down a lot. It's just, there's not enough information for us to do that. But there's a lot of people in this business, yes, 100% fee-only fiduciaries who will look at your situation, tell you about having that plan, and be willing to provide a second opinion on your portfolio. That I do know.
Yeah, it's just they're not your typical Edward Jones, Merrill Lynch, Morgan Stanley, Ameriprise, Voya, LPL people.
Okay, so I have my investments. I make my investments through Merrill Lynch, but I have like investments in BlackRock. Mm-hmm. Let's see, what else is here?
Can you give me the BlackRock fund, since you're looking at it? What's the name of the BlackRock product?
Let's see. It's BTZ.
Okay.
Looking at it on my...
Is the symbol DTC?
BTZ, yeah.
VTZ.
B is in boy. B is in boy.
T is in Tom. Yep.
Okay. Hold on.
And Z is in zebra.
All right,
yeah, that's the credit allocation.
Okay, that's the thing. Okay. See, you're getting things that are designed to create income, but you don't have a portfolio. What you have what we call a hodgepodge. It is a hodgepodgey mess. You must get rid of this advisor and get someone who's fee only.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And if ever there was the perfect candidate to meet with one of our advisors or to spend some time on a Saturday morning with Tom, it's Rachel. Rachel, you should call Tom at 800-386-3004 and set up a meeting with him, or with one of our other advisors, going to talkingrealmoney.com and clicking on Meet an Advisor. And there's one, I promise you that you will not be sold anything. I promise you that. You can call and beat me up on the radio if you want to. 2, I promise you, even if you just do that meeting and then go out and talk to other people, we don't care. We just want you to get the help because you're going to be better off just from that one meeting. Go to TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.